Good morning. I am pleased to be here today to join SP in welcoming you and to introduce our first panel, a fireside chat on current global macroeconomic trends affecting our capital markets. From my vantage point in regulating the asset management industry, there are really few topics as important as the one our distinguished panelists will be discussing this morning. Global macroeconomic trends have resulted in big changes in the asset management industry and more broadly in our capital markets. Both market participants and regulators are operating within a new and evolving landscape. One striking aspect of this landscape is the level of global debt, which now stands at approximately $250 trillion, or 320% of the world's GDP. In the United States alone, outstanding non-financial corporate debt is nearly $10 trillion and almost 50% of the US GDP. Now, the increase in debt is driven by various factors, and I'm sure the panel will be delving into that. For example, monetary easing by central banks has resulted in interest rates at historic lows. Further, global regulators have encouraged banks to hold highly liquid assets and less corporate debt, especially lower-rated debt. The combination of monetary policy and regulatory constraints on banks has contributed to a migration of debt investments from banks to other holders, including funds. In addition, direct household investments in debt have declined, with investments through funds accounting for some of that change. A report from our Division of Economic and Risk Analysis summed this up with the following observation. From 2009 to 2016, the percentage of corporate and foreign bonds held by households decreased from 22% to 8.6%, while the percentage of corporate and foreign bonds held by funds increased from 8.5% to 18.3%. This shift makes it more critical than ever that we understand the connections between banks and non-banks, and from my perspective, banks and funds. These connections include exposure of banks to funds through both lines of credit and as counterparties in derivatives and other transactions, exposures of funds to banks through holdings of equity securities, overlaps in portfolio holdings, particularly holdings that are more susceptible to liquidity shocks, and clearing bank supply of balance sheet capacity to permit client clearing. Interconnectedness, leverage, and liquidity are all topics we have talked about for years, but the conversation should not be static and should be done with the evolving market in mind. There are a few other areas where the shifting landscape requires an adaptive regulatory approach. For example, increased globalization has intertwined domestic and foreign markets and policy considerations. This is why we at the SEC spend a great deal of time working with our international counterparts, including through organizations such as the FSB and IOSCO. Advances in technologies have enabled efficiencies and innovations in recent years. With that, however, comes heightened cyber risks, as well as new business models and products, including robo-advisors and digital assets. The growth and evolution in the asset management industry has increased opportunities for investors. It also has given rise to public debates about concentration risks, common ownership, and the effects of index investing, to name a few. To be clear, observing the activities or risks have changed is not to offer an assessment on whether these changes are good or bad. That said, change does mean that market participants and regulators need to reevaluate risks continuously and make the necessary shifts in risk management and oversight. Recognizing change and modernizing oversight to meet that change will enable us here at the SEC to meet our mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. As regulators, I believe that we have to work harder and use all available tools more effectively in this changing landscape. We don't operate in a vacuum, of course, so one important tool is engagement with market participants. In that regard, events such as today's conference help keep us informed of market developments that impact our mission. Let me now turn to our distinguished panelists for their take on macroeconomic trends and how they affect the markets. Our chairman, Jay Clayton, will be joined by Gary Cohen, former director of the U.S. National Economic Council, and Glenn Hutchins, co-founder of Silver Lake Partners. The accomplishments of these individuals speak for themselves, and I will refer you to the program for their detailed bios. That said, I do want to note that this group brings unique perspectives and experience as global investors, advisors to governments and leading companies, crafters of public policy initiatives, and supporters of the study of markets. I'm sure you're going to appreciate their perspectives, and with that, please join me in welcoming our first panel.
Dahlia, thank you very much, and let me just extend on behalf of my colleagues here at the SEC, thanks to Gary and Glenn. We're going to talk about where the markets are.
I wasn't told I had any choice being here, Gary. How about you?
I'm in a similar camp.
Okay, good.
I wasn't going to admit it
got an
publicly.
order from the chairman.
Wasn't going to admit it publicly.
So when the SEC calls, you still come?
Yes.
Okay.
Yes.
Especially you, Jay.
Okay. Look, I could think of two better people to give us an assessment of where we are and where we're going in terms of market function and the risks and opportunities we face. So just thank you both very much for being here. So let's get right into it. Glenn, you founded Silver Lake 2 decades ago, and you had a belief that the power of technology was underestimated, that it was going to transform our economy. How do you think technology is affecting our markets today? Where is it going to be 10 years from now? Your thoughts? I mean, this has been a driver of your investing philosophy for years.
Sure. So for people who don't know, I've invested. I was into fintech before fintech was cool, and investing at the intersection of financial services and technology for the last 20 plus years. I helped to build companies such as Ameritrade, the NASDAQ stock market, and now Virtu, which is a high frequency market maker. And I think the biggest thing that's the biggest thing that happened in financial services technology over that time period, and Gary and I had a conversation about this a couple of years ago, I recall, is when I first addressed these markets 20 years ago, cost of trading was, for a retail investor, an eighth to a quarter plus a commission. Mm-hmm. And you waited, you made a phone call, you waited a couple hours to see if you got the trade, and then you settled 5 days later, wasn't it? Something like that.
Yep.
Now at Virtu and across the markets, we trade securities in microseconds, which is a millionth of a second. The binding constraint is literally how fast you can move electrons. That's the binding constraint on how fast you can trade. And at less spreads that are less than a penny. And that means that the cost of trading has been reduced by 99% or more over the course of that time period, and the speed is increased at an infinite level. And then for a whole bunch of other kind of reasons, we're moving, as we'll talk later on, and there's a new level of, we have the same capacity to make as big a transformation in the next 10 years as we had in those last 10 to 20 years, for a reason we'll get to later on. I think that's the biggest change, though.
That's the biggest change. Well, and look, Gary, through policy making and whatnot, you've been able to identify where conventional wisdom holds true and where conventional wisdom no longer holds true going forward. You know, technology, other areas, as you see government policy, where are we going where maybe technology is going to change conventional wisdom?
Well, look, I agree with everything Glenn just said on what technology has done to the markets today as we know them, as far as speed of execution, ease of execution. We still haven't figured the clearing thing out yet, Jay. We're still clearing like we move physical securities in horse and buggy, but we'll get to that later. I don't understand why we're not real-time clearing.
There's no technological constraint.
There's no technological constraint. There's other constraints. There's really no other constraints. We just need to start going to real-time clearing. When you talk about safety and soundness, that's a way to get safer and sounder. But when you think about where we are right now, and look, the United States has enjoyed an enviable position, being the dominant capital market in the world, both debt and equity. We've owned that position for a long period of time. We are on the fringe, and the fringe is important here. We're not in the middle. We're on the fringe of potentially losing that position. And I say that because the capital markets around the world are developing quite quickly in a much more digitized fashion than the U.S. has developed. The U.S., although we've gone to high-frequency trading, we've gone to digitized trading, we now see a lot of technology being used in other parts of the world, whether it's as simple as payments in China. And look, it's a lot easier to use payments in China, digital payments, because you have a relatively unregulated banking system. And I'm not espousing that we should go to an unregulated banking system at all. I think we have to do payments in a very regulated fashion, but we have to embrace that. We are now seeing digitization of more and more asset and more securities. I think that we have to embrace this digitalization. We can't say that everything's going to trade in the traditional way it's traded for the last 100 years, and this is our sandbox, and we're going to stay in this sandbox. So I think the fringes around the edges are starting to get clawed away. I still think that this is the dominant capital markets in the world, and it's sort of in the hands of the regulators right now to sort of lead, not follow. And I think you have an interesting opportunity to lead.
So you're telling me in a nice way,
Lead.
recognize
Lead.
this is happening and make it happen in the right way.
You said that, I didn't, but what I'm saying is, look, we've been so dominant for so long, we could always be the slowest moving animal and survive. I don't believe we can be the slowest moving animal and survive. The world's too big, the world's too global, there's too much money. We need to get in the middle of the pack. And right now, I don't believe we're in the middle of the pack in technological evolution of our marketplace.
So if you think about, one way to think about this is we've built out the internet over the course of my 25 years of investing around this stuff. First, we used it to create messaging, TCP/IP. Then we used it to create mail, SMTP. Then we used it to get to websites, HTTP. Actually, there was something called FTP in the middle, which allowed you to attach files. HTTP, TTP for websites, VoIP for voice. Now we're building it out for video. That's what all this streaming is all about, and all the investment is happening there. And the next thing is going to be value. And the question is, how can we use the internet to move anything of value at the speed of light at no cost, the way we've done all those other things that we've done? And to do that, we have to have a regulatory framework, like Gary's suggesting, that can keep up with that, rather than try to fit that new paradigm into an old regulatory paradigm. But also, we need to recognize that we have to adopt a technological leap forward, because the reason why the Chinese in particular, I've invested in some of these Chinese payment modalities as well, were able to do this is because they didn't have the credit card system with which to contend. Mm-hmm. It wasn't there, so they could go right, just like they skipped over landlines and went right to cellular, and there are a whole bunch of reasons why so they now pay, but even without fundamental technological innovation, the cost of payments in China is about 30 to 40% of what it is in the United States.
Yeah. Look, the message I'm receiving from you is safety and soundness, transparency, investor protection, all very important.
KYC, AML, audit trail, all important. But don't give up on those. But those can all happen in the digital world.
Actually,
the
it can happen much more
technology
easily.
exists.
They happen much more easily.
Don't use yesterday's technology to achieve those goals. Use tomorrow's technology to achieve those goals.
Yes. Another way I look at this is, you look at, Glenn gave you an actually unbelievable tour of the internet in 30 seconds. I don't know how he did that without notes. But if you look at sort of the phone, which is where the world is right now, we went from landline to what I would call the brick phone. I remember my first cellular phone. You needed your own briefcase to carry it around, and you walked around with the brick phone. And then we went to the smaller phone. So we went to sort of the flip phone. And then we went to the smartphone, and now we're going to have to go to the secure phone. So that's the next part of it. And once we get to the secure phone, we're going to be able to use that secure phone for everything we need financially. And when I say we need to go to the secure phone, we're virtually at the secure phone line right now. And 5G, and we're at the edge right now.
Talk about 5G later if you'd like.
Yeah.
Keep going. You have more.
No, let's look. Message received on technology.
Okay.
But
we can keep hammering on it.
No, I think it's.
Here, take a step.
We can't let it pass us by.
Right.
But we are already behind. In other words, the payments modalities in Asia are much better than they are in the United States. And this is not, but it's not primarily a regulatory problem. It's primarily a legacy issue associated with the credit card companies. Because the payments system in the United States is the only place I've seen in my career as a technology investor where the introduction of technology caused the price to go up. Usually, we've had these cost curves that drive prices down, like we talked about in securities trading. But in payments, they've gone up because Apple Pay adds a quarter, Stripe adds a quarter of a point, Square adds maybe even a point more. So payments go from 2% to 2.25 to 2.75. That's actually ripping off the consumer and making financial inclusion harder to accomplish rather than easier. And if you actually thought about the broader purpose of this kind of organization like this, you ought to actually be out there facilitating the introduction of technologies to take these prices down, to increase consumer fairness and expand financial inclusion. Yeah. So I'd think about it that way.
No, I think, and to be clear, I'll give my usual disclaimer that my views are my own, and I'll also say I'm not going to pass views on any particular company. You guys are welcome to. But I will say the one thing we are devoted to here over our 85 years is that transparency in pricing benefits the consumer.
Absolutely.
And
Right.
that is clear. And to the extent technology enables us to provide transparency in pricing, it benefits investors and consumers. All right, so let's shift from technology.
We're not going to shift. It's going to keep coming back in every answer. Okay, just so you know.
I've never, ever been able to control Gary Cohn. Okay, monetary policy. Now, I know you have a disclaimer.
Right.
You're a board member at the New York Fed, and your views here are your own, not those.
Don't worry, they don't listen to me either, so don't worry.
So, but we've had a run of accommodative monetary policy, probably the longest run in history. Affects how we should look at that. Where do you think we're going? I believe it's driven some changes in the market, but including, as Dahlia outlined in her introduction, a shift to more debt, and due to some other regulatory events, a shift in debt from debt being held by banks to being held in our capital markets. But your thoughts?
So I think the thing that most concerns me as an investor in this space, an investor in this moment, is that these very low nominal interest rates, we can come back to what real interest rates really are later, but these very low nominal interest rates cause every layer of the risk structure to search for yield. So people who would normally have bank deposits buy treasuries, people who would normally buy treasuries buy corporates, corporate buyers go to high yield buyers go to equity buyers go to illiquids. The people who are normally in the illiquid space take on more debt and go to late stage growth, and the whole layering of risk involves with people reaching for yield and taking risks that they're not accustomed to taking or not professional at managing. And then when that reverses itself, it has the risk of reversing itself rapidly in a way that's reasonably predictable. Mm-hmm. So that's my biggest concern about how the markets are operating right now. We can get into what that means in each of those segments.
So, actually, let me tee this up for Gary this way. There are some people that believe we're in a lower for longer, and then there are some people who believe that a snapback. How do we get to somewhere in the middle?
Can I make one comment before you say that? One of my rules of investing is widespread capitulation is the first sign of the bottom. Mm-hmm. As soon as people say interest rates are going to stay lower for a very long time period, that's when you ought to be prepared for them starting to go back up again.
Glenn, I've been saying lower for longer for 5 years, just so you know.
That's low.
I remember.
Right, Gary, go ahead.
If you remember back 5, 6, 7 years ago, we were talking about interest rates and the economy, and we were using letters of the alphabet. We were talking about V-shaped, U-shaped, right. J-shaped, and I said, think of L-shaped.
Right.
Okay, so I've been saying it for 5+ years. But Jay, I think you almost have to back up here. It's almost difficult to answer this question without saying, how did we get here? And I won't drone on how we got here, but you've got to go back to 2008. You've got to go back to the financial crisis. You have to understand that central banks around the world, in a coordinated effort, basically decided, and justifiably, I'm not saying they did anything wrong, justifiably decided to flood the system with as much possible liquidity as they could, and threw every dollar, yen, sterling, euro, anything they could at the system. And they literally put it in the system, and they put it in, and they wanted to stimulate growth, and they wanted to make currency available as cheap as possible. They also did that simultaneously with the two big saving economies aging into that older population, where Germany and Japan, they're not going to spend the money no matter what. We've already proven you can put negative interest rates out and they won't take the money out of the bank. And so this idea that we can get savers to become spenders because we send a negative influence by taking rates negative, we've proven that if you're a saver, you're a saver. If you're a spender, you're a spender. We could say the same thing in the United States. We could probably make interest rates 10% and people wouldn't save. In Japan, you can make rates negative and they won't spend. So we started with this whole issue of creating global liquidity. We're now at the sort of 10 years from the other side of that pendulum where, 08, 09, flood the markets with liquidity, lower interest rate, ease. And now we're trying to figure out, okay, we really haven't created growth out of that easing policy. We have not stimulated the way we wanted to stimulate. How do we stimulate from here? Negative interest rates, and this is a personal opinion, or I guess all these are personal opinions, have this very negative unintended consequences, especially as you have aging populations, and they dissuade savings, which is exactly the wrong thing to dissuade, and they make people on fixed incomes more financially insecure, not more secure. So now we're in this part of the equation where we're trying to say, okay, what should we do? How should we do it? How do we get the economy growing? We've proven that sort of throwing money at the situation doesn't just create growth in the world. And a lot of this, I believe, happens to simultaneously go with a lot of the regulation that happened after 08 and the fact that the world has become more and more globalized. And so one obvious example I'll use, since we're at the SEC, I'll talk about a financial service example. You look at the financial services industry in 08. The regulation that was forced upon financial services industry was so enormous that every financial service company, basically in the large asset managers down to every bank, was forced to add enormous amount of regulatory cost to their system, but they couldn't afford that regulatory cost. So they all of a sudden figured out, if we can export labor to cheaper markets and arbitrage the labor cost, we can then afford to be in this system. So lo and behold, Bangalore, a city where I couldn't have found on a map 15 years ago, now is a city with millions and millions of financial services jobs where we can hire someone for $35,000 a year doing the same job that someone in New York would do at $135,000 a year. So we've created this labor arbitrage market that we all got very smart to in the world. And once Bangalore got to $40,000 because we were hiring everyone, we found the Philippines, or we found Poland, or we found all these other markets. And because of necessity, we've now created this global labor market where you just keep finding cheaper and cheaper labor. And when you find cheaper and cheaper labor, you don't have wage inflation to the extent you want wage inflation. You don't have any inflation in the system. So in a lot of reasons, throwing money at the situation and regulating the situation just forced people to get a lot more creative on the situation. So in my opinion, we almost have to figure out a way to start withdrawing the liquidity from the system. And it's going to be a slow, long slog. And in many respects, the Fed tried to do that. They tried to cut their balance sheet down. They tried to go through a very slow process of retiring their balance sheet. And these are the right steps to go back to what we would consider a normalized environment.
Yeah. Now, Gary touched on some things. I'm going to do a little bit of a segue here, but I know it's an area you know a lot about. The way the macro economy operates today. We touched on technology. Gary's talking about availability of labor being a global issue. We know capital moves faster. We know supply chains are real time. Glenn, are we measuring technology and the effects of technology in the right way when we make policy?
This is a very good question. So if we were sitting here 2 years ago, roughly, and we started talking about Fed policy, we would have all assumed that we're heading towards something called normalization, which was basically rates are going to go up, the balance sheets are going to go down, and we're going to be to a place where it looks more normal relative to historical experiences, and there's what's called policy room. So then when the next recession comes, you can drop rates, you can expand the balance sheet, you can do it all over again. And we sit here 2 years later, and the markets couldn't digest that. Right? The little bit of rate increase had not just market effects, but also real economic effects. and recently, as the balance sheet was being shrunk, the repo markets are sending signals that there's not enough liquidity out in the system. So what's wrong? What do we, so you look at that and you say, what don't we understand? And as Gary suggested earlier, I think today you have to extrude every question through this dimension of what is the impact of the transition we're on, the fundamental historic transition we have from the industrial to the information economy, and what aren't we understanding well? So let's think of, and one of the things people are telling us is economists tell us is the reason why we haven't got good growth, economists tell us, is demographics and low productivity growth. That's the answer in the numbers. Right? I mean, you talked about some of the demographic trends earlier, but it strikes me as unlikely that we are experiencing low productivity growth during the information revolution. In fact, it strikes me that we have enormous productivity growth, which we're not measuring. Do an experiment one day, if you have a few minutes. Put 2 columns on a piece of paper and put on what you pay for everything on this device, and then put in the other column what you used to pay for all the things you bought that this device now does for you. And I stopped when I got $1,000 on one side of the page and $20,000 on the other. This is the greatest deflationary tool I've ever experienced. So if you think about it, maybe we're not measuring productivity correctly. If we aren't measuring productivity correctly, perhaps that means that the economy is growing more rapidly than we think and we're not really measuring it well. And if that's the case, the math means that we're actually in deflationary times rather than inflationary, modest inflationary times. So let's just take a number. If we're actually experiencing 2% deflation rather than 1.5 to 1.7% inflation, then real interest rates at about 1.7% 10-year are more like 370 basis points, which is about the historical average for real interest rates. And so that, and if you imagine that we're at the normal average for real interest rates, the economy is behaving almost exactly the way you would expect it to as you try to increase interest rates in that time period. So it could well be that we're not measuring the economy correctly as a consequence of which not understanding the effect of the policies that we're applying, and as a consequence of which aren't really thinking about the right policy mix.
Sound right?
Yeah, no, I don't disagree with that.
It's just hypothesis. I'm not saying that's the case.
In the U.S. economy,
It's a different lens.
it's a different lens.
It's a different lens, but it provides some insight. I mean,
Right. It's a different lens. And remember, our economy in some respects gets harder and harder to measure as we become a dominant service economy. You know, we're 80% service economy, GDP and jobs in the United States. So we're not measuring our economy on how many cars and how many machines and how many airplanes we put out. We're measuring our economy based on how many people are going to get Starbucks coffee, and how many people are going to the dry cleaners, and how many people are going to the nail salon, and how many people are going out to dinner. I mean, that's really our economy, and how many people are buying banking services and accounting services. And the big point is how many people are buying our technology and our technology products, and are they actually paying for our technology and our technology products? But maybe we'll get into that, or maybe we won't get into that later.
And if the price of one of the things goes down, that's less GDP.
It's less GDP. And so, like, airplane transport, air travel in itself is one of the very deflationary things. You know, the price of an airplane ticket, price of computing power, Moore's Law, all these things become very deflationary. And as higher end retail stores selling things have moved out of inner cities and more service businesses have moved in, the marginal rate for rent they're willing to pay is less than someone selling goods. So rents have come down a little bit. So retail space is worth less today. But you're employing more people at different wage levels. So a lot of what Glenn is saying resonates with me. That we're just we're trying to use 20 and 30-year-old isolated domestic U.S. measures in a globalized world.
Yeah. Older, more domestic than global.
Yeah.
We need to look at where we are today. And I do want to, before we shift to technology, because I want to get
We're
back
shifting to technology?
shifting.
Just kidding.
No, I love it. I love it. The discussion we had about more credit being in the capital markets versus in the banks. How should we be thinking about that?
That's Gary's world.
So look, this is one of these issues that sort of irks me. Because getting it out of the banks is probably the right place. I mean, financial crisis of 2008 was the bank's balance sheets over-levered with credit. When you get it into the capital markets or into the asset managers or into the consumer, all those asset managers and all those other places are basically the consumer. This great idea that U.S. citizens don't own credit and U.S. citizens don't own equities is really kind of interesting because, back in my good old days when I used to work for a living, when we sold stock and we sold bonds, our biggest buyers were the pension funds from the teachers' unions and the police unions and all those things. I thought those were just normal people, and so they actually own those assets. So we were disseminating those assets into what I would call retail America. The question to me is not who owns those assets. I mean, it's really not who owns those assets. The question to me is how much leverage is there behind those assets? Because that's what ultimately comes down to the whole financial crisis, the whole stability and safety and soundness of the system, is if there are hedge funds owning those assets or there are asset managers owning those assets and they're paid in full, there's no issue, there's no problem. The only problem is they can go down in value, but look, there's ways, that's what happens. Markets go up, markets go down. To the extent that they're leveraging them and they're being provided a lot of leverage through the banking system ultimately owns the risk anyways. Because the banking system can ultimately, if the ultimate owner defaults or can't repay them because they're over-levered on their credit portfolio, the banking system bears the brunt of it. So to me, that's the question, Jay. And I think based on where we are on the regulation that we have today, and this is one place where regulation works, where the banks are stress tested, and they go through their CCAR, and they go through all of their testing with the Fed, I don't think the banks are over-levered and extending credit to people that own credit today.
Okay. And
I was going to say two things. You guys might disagree with this, but I think first thing we want to do is, understand history correctly, which was, it was really the securities firms, not the quote-unquote banks, that were the ones that failed and got into trouble.
Well, thank you for saying that, but that would have been self-fulfilling for me to say.
Just so we know, right? It was Lehman Brothers and Bear Stearns and maybe some thrifts.
Oh, I was a security firm back then.
Yeah, you were a security firm back then.
Well, until Sunday. Then I was a bank.
And the solution was for you to become a bank.
Right.
So it wasn't quote-unquote the banks that failed. Yeah. It was the securities firms that were doing maturity transformation. So if you had deposits, you were in pretty good shape.
I agree.
It was the securities firms that were borrowing short and lending long and accumulating, in many cases, bridging things before they could securitize them. And it was also money funds doing a very similar thing as I talked about earlier, maturity, sort of reaching for yield, that were kind of, supposed to have short-term securities. We're buying slightly longer-term securities in order to kind of get more yield. And so what I would do is I'm really trying to understand kind of where the risks are in the system. It's really where people are doing maturity transformation, which is what the economists call borrowing short and lending long. And so I'd look for that through the system. So you mentioned something we were talking earlier about where the leverage is. In other words, I'd be less concerned about a private equity a credit private equity fund that's got commitments of capital for 10 years with 2 one-year extensions, so it's 12-year money. They're out buying high-yield debt in the markets, and that debt might go up, might go down. It might have to be marked to market. They might have some bad reports, but there's no capacity for the investors to say, I want my money back. The big problem that happened in the financial crisis was there was this massive capital call all across the economy. Everybody said, I want my money back. I want to sell my securities in order to cover my obligations. And that's the place where I would look and make sure that there wasn't a problem. So it would be leverage inside these companies, short-term leverage inside these companies that are lending long by buying long-term credit-based assets. That's where I'd be concerned.
And are subject to liquidity stress.
Yeah, exactly. Yeah. Exactly. That's borrowing short. Yeah. Yep. Whereas the lender can say, I want my money back.
Duration mismatch. Sure.
Yeah, exactly.
And we should always be looking for duration mismatch.
I agree. Duration
That's the place to look.
We saw one of those this year.
But I think there's something I do worry about a little bit that is out there, and it's less this issue, but it's more because the problem always comes from where the bubble is. And the bubble right now, one of the bubbles in the world right now, looks to me by this massive movement of money toward index funds. That's been the biggest thing that's happened post the crisis. So I'd take a very good look inside that and see what the ramifications were of that reversing itself in some important way, because that's the biggest transformation in flow of funds that's happened, other than what's going on in the Chinese banking system, which is a whole different kind of thing. That's happened since the financial crisis. That's the part that I look at and wonder about, what the implications of it are.
Yeah, let me give you one data point that I ask people, and I think this is an appropriate forum to say that I ask people this, about indexation. I often say to companies, well, if it's kind of a passive strategy, how much would a company pay to be in a very popular index? I think the answer is a lot.
A lot.
So, tells you something, right? I mean,
Well, look, I can give you some relative values that, so it used to be, and I'm dating myself now, you got announced that you were added to the Dow. I think that was like, we're 7 to 12% of the value of your stock, back in the days when we used to do big index rebalances. And, the movement on any day when a stock would go in or out of a bigger index, would be anywhere between 2 and 12%.
and you guys are investors, you know this better than I do, but that means your cost of capital is actually goes down, right?
No.
So
Yeah.
Oh, sure.
it's got value.
It's got a lot of value.
Nothing happened in the company
Pay a lot for
except
that.
more people were forced to own the security. Now, the contrary happens when you come out of an index. Okay.
Right. But the thing, if you're heading toward kind of where's the risk in the system one should be worried about, can I expand on that just a little bit?
Please.
Mind about that? I think the two places that we're paying insufficient attention to the risks of the capital markets is climate change and cyber risk. And with respect to climate change, Mark Carney, the head of the Bank of England, has spoken, I think, very intelligently about that there's a potential risk in the insurance markets in London, which are a very important part of the financial system in London, to the cost of the growing insurance claims for climate change-related kind of issues. And so I would say that from your perspective, I would say making sure that companies are adequately disclosing their exposure to climate change and the risk in their businesses associated with that is very important. And with respect to cyber risk, I think the potential next financial crisis is more likely to come down that dimension than the dimension of sort of maturity transformation. There's a book I think everybody should read called The Perfect Weapon. I know you have it. I think I gave it to you. And which is about the last 8 years of cyber competition among nations. And the author, who's a Pulitzer Prize-winning New York Times reporter, hypothesizes in the last chapter what the next war could look like. And it would start with our adversary turning off our electrical grid and our financial system, and then telling us to surrender before they attack without firing a shot. And the vulnerability of our financial system to cyber, almost every one of them has been intruded upon. If any company out there or bank tells you they haven't been intruded upon, they're not telling you the truth. All of them have been intruded upon. All of them are vulnerable, and being able to kind of put up those defenses and understand their financial soundness implications is very important.
Yeah, I think what I can say is this is an ongoing conversation. It's a very important conversation. My view is the conversation has matured to some extent. We're now talking about resiliency as opposed to defenses. When something happens, how do we recover? I think that kind of conversation needs to go on. I also think, let me just say, the liquidity issues we talked about, as history shows us, there's usually a catalyst that drives those.
Yeah, that's a good point.
And I could see technology being that kind of catalyst.
Right.
I hope that our investors and consumers understand that we will have technology issues. They will happen.
Yep.
The question is how we deal with them. Are we prepared? Do we have the resiliency? Can we move forward? But that's a good shift. Crypto assets. What do we think about crypto assets? I mean,
You have a problem with your left hand today?
Go ahead. For once, you're to the left of me.
So, yeah. Wow. It's hard to get to the left of you. Crypto assets. So look, I think you got to break this down because we conflate crypto and blockchain in America. We think they're synonyms. They're not at all synonyms. So I will be pretty quick on crypto. I am not a real believer in sort of the cryptocurrency world. Glenn may vehemently disagree with me on this, but I am much more of someone that thinks in the United States, we still believe in safety and soundness. We believe in KYC, we believe in AML, we believe in audit trail and some regulatory oversight. And in the crypto assets that are out there are sort of the antithesis of that. So to me, they are going to be tough assets in the United States. That said, so take the currency side of it out. The technological side of it is unbelievably important and is going to be part of a huge evolution that's revolutionary in our business. And you're already starting to see what the blockchain can do and how the blockchain can be used in all industries, but it is extraordinarily relevant in financial services, in consumer credit, in areas where we as a financial service country, we as a capital markets country, we'll use it day in and day out, and I think it will have enormous impact across the entire spectrum. I think if you're not thinking about it really broadly when it comes to financial services, you're missing enormous opportunities, and there are enormous amount of companies out there in each of these little silos trying to perfect and figure out exactly how they make it work, and it's really kind of simple. And Glenn got on this topic, and I'll just elaborate on it for a minute. You know, this old idea that we created all these data warehouses and we kept all this important information on individuals and on their creditworthiness and on their financial information, we kept it in data warehouses. Well, that was cutting edge technology when it was built. But the bad people out in the world, they knew those warehouses existed, so if you wanted that information, you might as well go to the place where all that information is stored. That's why people robbed banks, because that's where the money is. If you're looking to steal identities, you go to the place where all the identities are held. In the blockchain world, you can get rid of all of those data warehouses. You can create the identity real time, instantaneously, have it created, and then have it disappear. And so think of the ability to create things on a real-time basis as you need them, use them, and then have them go away, and you can get real-time information, not the information that was sent to the warehouse. So there's just enormous amount of applications for this, and whether it's digitizing securities, moving securities, fragmenting securities, it just has enormous use. So I am very, very bullish on what it's going to do to the industry, and this goes back to where we started, how the SEC, the CFTC, the Fed, they're going to have to understand that this is going to happen with or without you, and it's better off to happen with you.
Okay, a couple things. All that is accurate. Let me just give us a different, slightly different perspective on it. Let's talk first about digital currencies, and let's talk about crypto stuff. Digital currencies today, roughly 92% of all currencies in the world is digitized.
You're talking about fiat versus crypto?
Just currency.
All right, so break them up though. So look, I totally believe in digital fiat.
Yeah, that's
so
right.
Digital dollars, digital yen, digital euros. I don't. Those aren't crypto to me.
That's right.
That's digital fiat. So I just want everyone to understand that we're probably in more agreement.
No, it's not agreement. I'm just saying. Okay. I'm sort of dividing these two things apart, just like you just did. So the first thing you have to understand is that moving to a digital currency is a very straightforward thing to do. Some people call them, and the two things can interact, of course. Some people call them stable coins. Some people call them, the Chinese are working on their own. Taking that thing on paper and turning it into a digitized thing is a very straightforward thing to do, and today, the vast majority of money in the world is already digital because it's just electronic entries at banks and central banks. So the notion that it's some big revolutionary thing, I can take 8%. By the way, Ken Rogoff's book, The End of Cash, says that the 80 to 90% of US $100 bills are used in organized crime and tax evasion. So the thing that's most useful to the bad guys is cash. It's the ultimate sort of anonymized security. But anyway, so that's a straightforward, easy thing to do. It should be done, and kind of we just got to get there.
Agreed.
Right. That's the end. That's easy.
Amen.
Now, if you talk about the whole crypto kind of world, I got to this from the kind of the payments thing because I've been looking for a way in which we could take the cost of payments down by 99%, the way we've taken out the cost of trading in securities. In the payments world, we use the term, we oftentimes use the term of the payments rails. There's the credit card rails, there's checking rails, there's the FedWire rails. Moves around. So let's to understand how I think to think about the cryptocurrency world is there are three parts of it: the blockchain, the token, and the protocol. And the three of them operate together to create one solution, one integrated solution that has the capacity to revolutionize the way we move things of value around the world. Let me use a railroad analogy to make the point. The token is the equivalent of the boxcar. It's the thing into which you embed something of digital value that needs to be moved from one place to another, from one part of a blockchain to another. The blockchain is the cargo invoice, is the invoice in the cargo manifest. And the rails is the protocol. And you have to think about all three as one integrated solution that enables you to accomplish the purpose of moving anything of value around the world at the speed of light at no cost, the way we talk about email today. People who just talk about blockchain are talking about something very interesting, but it's a piece of enterprise technology that's an advanced database, and a private blockchain unconnected to the global, to the Bitcoin or another digital currency blockchain is the equivalent of the intranet. Mm-hmm. Remember when we had intranets to begin with, where it was really cool, you could do internal communication with people in your own companies, but it wasn't really until those intranets were connected via the internet protocol to other intranets to create the World Wide Web of intranets called the internet that the world changed. The world is going to change in finance when we connect the private blockchains via the Bitcoin or Ethereum or other protocol to the other blockchains in the world, have a global blockchain that's the World Wide Web of blockchains that'll fundamentally change the way in which not only do we move value around the world at the speed of light, but also in which we actually fundamentally change the way in which we compute, because it's the fourth computing paradigm I've experienced in my lifetime, the decentralized computing paradigm. That is the vision of where we can really go with this that's transformational. Now, the first step will be the intranets, mm-hmm. the blockchains, as those get deployed. But that's not the end point, that's just a first step. And go into all that stuff at greater length if you'd like me to, but that's a beginning.
No, look, transformative. I want to go back to something we talked about around monetary policy, which is if this happens, which I say if, I think you're saying when. I get it.
You have a little bit more to do with the if than we do. I'm just kidding.
No, and look, Jay, my view is it's happening.
Yeah.
Right. What is the U.S.'s role?
Right.
Yeah.
Well, that's where
I'm gonna go further
point.
because
do my right hand. Yes, you're right.
Yes, because we're both involved in companies that are doing it. Mm-hmm. We'd like to do it here, but we're gonna do it.
Well, let me ask this back to what we were talking about, measuring things in our global economy. Mm-hmm. This also sounds incredibly deflationary because of the costs that will be driven out of our system. Agree, disagree? Yeah. I mean, if we're going from paying a percent on a retail basis, 2%, 3% to move things around to virtually nothing.
Well, let's maybe the nomenclature is important. Deflation is not necessarily a bad thing.
People need to understand that. If it's cost savings,
if my being able to buy something at a lower price,
it's just part of the dual mandate. That's where the problem is.
Right, exactly. Right.
No, but let me say,
but the mandate is about real interest rates.
Yeah.
Let me put this at a U.S.
But Jay, the question is, who pays? This is
where I'm going.
Okay. All right. Then ask your question.
My question: You want to
See how nice I guessed I am?
You want to be in the position where you've introduced this cost savings across the globe. Mm-hmm. You don't want to be a taker. You want to be somebody who leads in this area, is I think what you're saying. Because we now do have a global economy, and these savings are global. You want to be a leader. Look, been a leader in many things.
Mm-hmm. Agree. So look, the issue is in Glenn and I haven't talked about this before. It's interesting. We're having our first conversation on us both attacking sort of the same problem. The friction in the payment system is huge. It's not seen by the consuming public. It takes away from their purchasing power because they just pay the marked price, but the seller, the retailer, gets 97 or 96 or 98 cents on the dollar when they go turn in their credit card receipts or their payment receipts. They just know they're getting less than par every time they sell you something in a store. If the retail seller could get par, this is the interesting question, would the prices come down 2 or 3%? We don't know the answer. But someone eventually would probably figure that out. With the amount of technology and digital sales and digital outlets, you know it will happen. It takes one first mover.
The power of shopping is unbelievable. Once people can see prices and shop, prices
exactly right. The market has become pretty efficient, pretty transparent. And there are a bunch of companies out there that will basically take your grocery list today and put it in the computer and tell you what grocery store in your neighborhood to go to where your all-in grocery list will be the cheapest. And so you'll get more and more evolution on this space.
All right, well, any last thoughts on this space? I think this has been a tutorial that
I just think that we ought to come back to, at the end, consumer welfare, because that's kind of what we're after, right? And that's not necessarily measured in prices, it's not necessarily measured in productivity, it's not necessarily measured in GDP growth or inflation. But the extent that you are offering something to a consumer that's better, faster, and cheaper than what they had before, that's a good thing.
Yep.
And the way we add it up on our economy and talk about it needs to be subsidiary to that insight. And policy needs to address the change, needs to be able, just like we talked about with crypto, just like we talked about now with Fed policy, it needs to change what tools it uses, how it addresses that based upon how the economy changes in the pursuit of greater consumer welfare, rather than try to use old tools and old frames of reference old lenses to understand the modern economy.
So look, on the consumer policy side, I will add one thing that I think is important. Glenn's talked about a couple of the major problems in the world, whether it be climate or things like that. There's another issue on social side. We all talk about banking the unbanked. A big problem. The payday lender should not exist in America today. It's one of those things that when I drive by them in New York City and see payday lenders, it's kind of shocking to me. In a digitized dollar, stable token, whatever you want to call it, world, we would eliminate payday lending. That has to be stimulant to the U.S. economy. Because if you could basically get your paycheck into a digitized wallet or into a stable token, take that wallet to any ATM, even if you pay the $2.50 ATM fee or pay the $4 ATM fee, I don't care what you know, versus paying 10 or 12 or 15 or 18% to a payday lender to get your money into your pocket, or use your digital wallet at point of sale, you're adding a huge amount of disposable income back into the system. And to me, that is one of the huge potential opportunities and windfalls that comes out of this technology.
And it has to be consistent with the SEC's specific mandate and the government's broader mandate of consumer welfare, social justice, and financial inclusion.
Yeah.
Right.
Let me make
and so thinking about it from that perspective is something we ought to go make sure gets done, as opposed to put impediments in the way of it getting done.
Then one more quick thing. Then you get to what Glenn said about the $100 bills. If you literally could get to a cashless society, you would basically have a society where your income taxes would become digitized. You basically would almost push a button at the end of the year. Everything would go in the system, and you'd hit calc. Or you could hit calc every day and see, and you could end up in a real-time tax society. There'd be no fraud, there'd be no anything in the world. You would have everything go through the system. And then this whole fraud and lack of collection of taxes, people say 30% of our taxes in the United States don't get collected. That's the problem. I don't know if it's true or not, but we can fix it.
But the other thing, and the last thing I would make point you guys understand is that you talk to law enforcement people who have actually spent time trying to track. Why do all the Bitcoin guys get caught? Because the public blockchain is a permanent, unauditable record available to law enforcement. right? So there's actually a whole law. One of the ways in which you get rid of fraud is that the public blockchain is out there for everybody to see, and the community is the one who validates every transaction. So you can go find exactly who did what when.
One of the things,
So it's very important.
Public service announcement for my colleagues here at the SEC, the women and men. Investor education is so important to us.
Right.
Investor education becomes a lot easier when you get rid of opacity and complexity.
Mm-hmm.
Yes.
When people can see what they're paying. I often say, in our economy, there are people who pay 8 to 18%, and there are people who collect 8 to 18%. You want to transition from being the borrower at 8 to 18 and as close to 8, not 18 as you can, to the person who's getting those returns over the course of your lifetime.
Yes.
We are trying to help people understand that. And to the extent technology helps people understand that, it's a wonderful thing.
See, I want to do something entirely different, right? Which is I want to get rid of that. In other words, that's just a cost in the system that is an inefficiency that needs to go away. Right?
I agree with Glenn.
Right.
We can get rid of those 8 to 18%.
That's just like the 8.25 plus a commission. It's just like doesn't have to be there for the markets to operate. Anyway, so go ahead.
By the way, but the funny thing is, at the time we had it, you couldn't imagine it ever going away.
Right.
But we are now at a place where we can get rid of that 8 to 18%, and I can not only can I imagine, I can see it.
You need a set of economic constructs in which not that one person gets it versus another person getting it, with which it's irrelevant.
Yeah, I agree.
All right, last topic. What's going on today? Brexit, trade, markets. What do we think about markets today? Any comments from either of you?
That was your right hand. I saw
That's what
that was a right. That was a right hand gesture, not a left hand gesture. So look, that's a how long is a piece of string question. So Brexit. Look, Brexit comes down to an election, right? And we're on a very short time frame here. If Boris wins, which I guess is the polling now, he's got sort of end of December to notify the EU he's leaving. I assume he does that. Let me give you a more sophisticated answer than that. It looks like he's polling at a high enough margin to get a majority government, but right on the edge. I assume he would notify the union he's leaving. He's got a year basically to leave, then he can extend a couple of years. So I think that's sort of where we end up. So it's a I guess people call that a quasi-hard Brexit, which to me, I've said this before, it's probably the right answer. We just can't keep living in the world of the unknown in Europe. It's probably the best thing that could happen. We'd stop talking about what is going to happen and what could happen in the future. I think it will be fine. The whole thing is, what do we do with trade agreements? How do we keep airplanes taking off from the United States to Europe and trade agreements? And most likely what will happen is we'll just take the existing trade agreement, we'll re-sign it, and keep extending it out for 6 or 12 months at a time until we can renegotiate new trade agreements, which will take years. So, I think the UK election, well, I know it will come and go, and there'll be a winner, and if that happens, if we end up with a surprise on the other side, we'll just live in this turmoil for, like we have been living for multiple years. Someone last night, I was at an event, they said, the bid offer is parity on sterling and 145 on the upside. So we're somewhere between parity and 145. The U.S. to me, we're in an interesting spot here in many respects, because the consumer continues to do what they're really good at in the United States. They're really good at spending money. Like I said, it doesn't matter what interest rates are in the United States, the consumer here knows how to spend. The consumer has basically, we're at 3% wage growth. They're taking their 3% wage growth and spending it. They're taking their tax savings to the extent they got tax savings, or they got additional child care credits, or they got additional credits in the tax system. They're saving it. They're taking their deflationary savings in other areas and spending it. They're taking their lower energy costs and they're spending it back in the economy. You look at Friday's Black Friday which was really online sales, and you take Monday, Cyber Monday sales, those were 2 record days. I mean, monstrous sales days if you look at the credit card data. So the consumer's doing what the consumer should do. So that part of the economy looks really pretty good. The one concern I have in the US, and I've had this now for a year and a half, is corporates are not spending money in the United States. And I totally get why they're not spending money. If I was a CEO, I probably wouldn't be spending money. If I sat on a corporate board, I wouldn't be doing big CapEx right now. First of all, if you start down a big CapEx project, it's property, plant and equipment, it's buildings, it's things like that. First thing you're gonna buy is steel and aluminum. Why would you buy steel and aluminum at the world price plus huge tariffs? So you look at that, the cost of that is expensive on one side, and then you look at the other side of the equation with the geopolitical uncertainty in the United States to what is it going to be potentially if we get a change of presidency. What is healthcare going to look like? Are you going to be able to have corporate profits? Are we going to have surtaxes on corporate profits? What are they going to do with corporate buybacks? What are they going to do with corporate legislation? It's a really tough environment to say, hey, let's take 10 or $20 billion and invest it in the US economy right now and look at it on a 30-year payback. I think a prudent CEO or a prudent board would say, hey, let's wait a couple years and we could probably make that investment in the future, or worse, we can make that investment in another country and import those products. So unfortunately, I understand why CapEx and corporate spending is down in the United States, which is disappointing to me, because one of the big motivating facts behind the tax legislation was to incentivize companies to spend money in the United States. That said, again, though, we still are at 3% wage growth. We're at sort of 3.5% unemployment. We still have 7.2 million job openings in the United States. So from that side of the equation, it looks pretty good. So I continue to be cautiously optimistic in the United States.
Go on.
So I've got 3 or 4 things on my mind that fit in that bucket. One is a fundamental change in the nature of the relationship between US and China that's going to affect the world economy for the next generation. It turns out that we misjudged Xi, and he turns out to be a real hardliner. Rather than the process that we had of China moving toward a capitalist economy, they are now very firmly adopting the model of state control of very important parts of their economic sectors and the state use of private actors for espionage and intelligence purposes. That's not going to change anytime soon, and so we're going to have a very, very different way in which the United States and China manage their relationship with each other in the coming years than we have in the past. One very good example of that now is largely an assumption in the technology community that we're going to have 2 internets on either side of a great Chinese firewall. That's kind of one. The second is that I was a public critic of the tax cut because I doubted seriously that it would increase economic growth, and it hasn't. It didn't, and whatever economic growth it offered was going to be fleeting, which it proved to be the case. And that I thought at that stage of recovery, given the level of federal taxes as a percentage of GDP, which was at well below historic averages, that it was time to get our fiscal house in order. I'm very, very concerned about the nature of these massive deficits the United States is running during a period of peacetime and recovery. And if you want to maintain the United States' centrality in the capital markets, one of the things you need to do is be a capital provider, not the world's largest borrower whose sovereign credit risk is deteriorating systematically. That's the second thing I worry about. Third thing I worry about is, even though the economy is strong and not strong, but the economy is growing, call it 2% trend, and unemployment is at historically low levels, you still have a massive amount of economic insecurity in the American household. The volatility in people's wages and the volatility in their spending, their low level of their savings without any cushion means that there's, even in a very strong economy, we still have this very profound sense of economic insecurity in very important parts of our country, and that's reflected in a whole host political and social and economic trends, and we need to address that, and a strong economy hasn't addressed it. Third thing. Fourth thing is I'm very optimistic because I am on the board of a company that I know is America's largest capital spender right now, AT&T, and is one of the largest capital spenders in American history. And we're building out the 5G infrastructure. By the way, my personal view is the reason why that companies that have good commercial propositions and can grow in the technology economy are actually investing quite aggressively. Take Amazon, for instance, as examples. And we're going to build out a 5G network that's going to offer wireless speeds at 50 to 100 times what you get today. You'll have a wireless experience as good, if not better, than your wired experience, just as 4G enabled the creation of a whole host of companies on top of that platform that didn't exist before, everything from Grubhub to Airbnb to Uber. There will be a whole host of new kind of economic constructs that will be able to be created on top of the 5G infrastructure that are going to create a whole new layer of economic growth. It's one thing that the United States will be competitive in, though China's ahead of us for a whole bunch of reasons, will be competitive in, unlike the digital currency stuff where that might migrate outside the United States for reasons we've talked about. And so that's a real reason to be optimistic. It's going to be a lot of fun to both invest in those companies and then watch them deploy products and services.
Well, I'm gonna close this out. I'll give you a chance to say any final things, but let me close it out with a few words here. First of all, it's wonderful to work in this job in a country where you can have this kind of discussion about how we look forward, the risks we face, the role of government, have it in front of people out in the open, talk about risks, talk about different perspectives. It is a great privilege. I know you've experienced it, but it is a great privilege to be able to live in a country where we can talk candidly, learn from each other, look forward, and try and do our job better. And that's what today is all about. And I just want to say I appreciate your sharing your views and sharing them in a way that we can all digest them and be better for it.
Can I say one thing before we go, which is, I don't want people to misinterpret what Gary and I both said, which is one of the reasons why we have the greatest capital markets in the world is because they're the ones that are the most effectively regulated and in which all the rights and expectations that investors have can be enforced.
Yep.
Can be predicted and enforced in the United States. So please don't interpret anything that we said today as being critical of this organization, because I see it as a centerpiece of kind of the financial markets. I have a huge amount of respect and admiration for everybody does, and I just want to make sure everybody understands. We're saying that.
Agree completely. Look, we would not be in the position we're in without the regulatory system we have in the United States, and I applaud it. Sometimes I'm angry at it, but I applaud it.
So thank you for what you're doing. We really appreciate it.
Now, thank you. Please join me in thanking these wonderful guests.
All right.
Thanks, brother.
Thank you. Very good. I'm going to